Hey Cosmic Crew, welcome back to We Are Cosmic, your home for deep dive crypto insights that go beyond the charts and hype. Today we're unpacking something that's shaking the market, XRP. If you've been staring at your exchange and freaking out about red candles, take a deep breath. Because what looks like a death spiral on your screen is actually hiding a historic story happening behind the scenes. And by the end of this video, you'll understand why panicking could be your worst move. Let's start with the hook. XRP's price has dropped almost 50% from its peak in July 2025. Most people see that and assume the network is failing. But here's the catch. The price is lying to you. Yes, you heard that right. While the market focuses on temporary losses, the XRP ledger is quietly growing faster than ever, adding 500,000 new wallets in a few months. That's not retail hype or random speculation. That's real institutional and network adoption happening in real time. Think about it. If the network were really dying, why would 500,000 new users jump in right now? 500,000 new participants aren't boarding a sinking ship, they're joining a ship that's docked at the right port. And this isn't just a small ripple. The XRP ledger has officially crossed 7.5 million unique addresses, a milestone most networks dream about. This surge in wallet creation signals massive organic growth even while the price is suppressed. The lesson? Don't judge a network solely by its price chart. Now, here's why this is important. Historically, when adoption grows faster than price, it creates a scissor effect. This happens when the network's utility keeps rising while price lags behind, often preceding major market reversals. Smart money understands this. They see the structural divergence and position themselves while others panic. This isn't just speculation, it's calculated accumulation by institutions who know that utility eventually forces price discovery. Let's talk engagement for a second. Drop a comment below if you've ever sold a crypto asset just because of short-term price swings. You're not alone. Retail panic is common, but in markets like XRP, it can actually create the perfect buying opportunity for professional investors. The $150 range we're seeing now isn't just a number, it's a foundation of institutional support that didn't exist in previous cycles. So, while small traders may be stressed, the big players are quietly building a floor. Before we go deeper into the on-chain evidence in part 2, here's the mindset to adopt. Treat your portfolio like a business, not a gamble. Analyze wallet growth, adoption rates, and liquidity, not just price charts. And remember, 2026 is shaping up to be the year of professionalization in crypto. Those who guess entries randomly might continue losing. Those who study the infrastructure, adoption, and institutional flows will be the ones ahead when the next phase of the Internet of Value goes live. In the next segment, we'll break down exactly how these 500,000 new wallets and the 7.5 million milestone signal a historic shift, and why the XRP ledger's growth might make the price correction we're seeing today a blessing in disguise. You'll see the charts, the numbers, and the institutional moves that are rarely talked about publicly, but they matter more than any headline. So stick around, because once we connect the dots, you'll understand why this market isn't what it seems. And if you're ready to think like an institutional investor, hit that like button, subscribe, and let's dive deeper. First, let's talk wallet growth. From late 2025 into early 2026, the XRP ledger added over 500,000 new wallets in just a few months. That's huge. To put it in perspective, wallets aren't just numbers. They represent real users and real participants joining the network. And these aren't random, inactive wallets. Daily active accounts are spiking, sometimes exceeding 110,000 per day, often coinciding with institutional announcements. This means both retail and professional users are actively interacting with the network. Here's the key point. The adoption curve is moving in the opposite direction of the price chart. While XRP dropped nearly 50% from its July 2025 peak, wallet creation and on-chain activity surged. This creates what analysts call a scissor effect, where network utility rises while price lags behind. Historically, this has been a precursor to major price reversals. In other words, the network is healthy even if the price is temporarily depressed. Why does this matter to you as an investor or observer? Because the price isn't the full story. Many traders sell when they see red candles, thinking the network is failing. But these 500,000 new wallets tell a completely different story. XRP is expanding faster than ever. More users mean more transactions, more liquidity, and eventually more demand. That's a classic signal that smart money watches closely. Speaking of transactions, let's look at activity. In January 2026, Daily XRP transactions fluctuated between 1.45 million and 2.68 million, hitting 6-month highs. That's proof that the network isn't just growing in numbers, it's being actively used. People are not just holding XRP, they're sending it, interacting with protocols, and participating in the ledger's expanding ecosystem. This level of adoption is crucial for long-term value because utility is ultimately what drives price sustainably. Another metric to consider is exchange reserves. XRP held on exchanges dropped to a 7-year low of 1.7 billion. Think about that. Fewer coins available on exchanges mean less immediate supply. Combine that with rising adoption and increasing institutional participation, and you get a classic supply-demand imbalance, which historically triggers sharp upward price moves once the market reacts. Here's where the institutional angle comes in. Large wallets holding 1 million to 10 million XRP are steadily increasing in number. These whales aren't reacting to daily price swings. They're positioning for long-term growth. While retail traders may panic during dips, these smart players are quietly absorbing supply. That's a strong signal that the $150 range isn't just a temporary floor, it's becoming a new baseline of institutional support. Now let's break down the bigger picture. Adoption versus price divergence. When you overlay wallet growth on price charts, you can see a clear disconnect. The network is growing faster than the market appreciates. The smart money understands this and moves first, accumulating assets while the market focuses on short-term volatility. This is why looking only at price charts can be misleading. You might see losses, but the structural health of the network is at an all-time high. First, let's talk about ETFs and institutional inflows. Late 2025 saw a historic 55-day streak of consecutive inflows into XRP spot ETFs. These aren't casual investments, they're strategic moves by professional funds and high-net-worth players. Even after the market experienced a $93 million single-day outflow in January 2026, analysts focused on the streak and understood something critical. Long-term accumulation by institutions is vastly outweighing short-term profit-taking. In other words, smart money isn't panicking, they're buying the dip. Next, consider the exchange reserves. XRP held on exchanges is now at a 7-year low of 1.7 billion coins. When liquidity drops while adoption and institutional accumulation rise, it creates a supply shock scenario. Simply put, there isn't enough XRP available to meet demand. Historically, this type of imbalance triggers parabolic price moves once buying pressure increases. And the interesting part, many retail traders are unaware of this dynamic. They're focusing only on price volatility while the smart money quietly secures assets. Now, let's break down the whale movements. From January to February 2026, wallets holding 1 million to 10 million XRP steadily increased. There was even a net increase of 42 high-tier wallets, directly contradicting the downward price trend. This shows that large holders are absorbing retail panic sales rather than selling themselves. This type of accumulation is rarely accidental. It's a clear signal that institutions see the $150 range as a generational entry point for the next phase of XRP's growth. Another important aspect is the shift from centralized to decentralized liquidity. While exchange balances are dropping, the XRP ledger's decentralized exchange volume is hitting record highs. Average daily transactions reached over 1 million in January 2026, proving that liquidity is moving into the hands of users and automated market makers. The takeaway? The market is professionalizing, and liquidity is no longer just controlled by a few large exchanges. This makes the system more resilient and less prone to manipulative price swings. Now let's consider the supply-demand dynamics. Institutions and whales are not just holding, they're positioning for yield opportunities. The XLS66 lending protocol allows large XRP holders to earn passive returns without selling. This transforms the ledger into a credit market where investors can generate yield while supporting network liquidity. This is a huge change in economics because it reduces selling pressure and aligns incentives for long-term growth. Here's another insight. Institutional flows follow the infrastructure, not the headlines. While retail traders react to news and social media sentiment, professional investors track wallet growth, network usage, and liquidity. That's why we see this paradox. Even when XRP price temporarily drops, institutional inflows, wallet growth, and adoption metrics continue to climb. The market is setting a strong foundation for the next bull cycle, even if short-term volatility makes it look like a bear market. First, let's talk about the Ripple National Trust Bank, RNTB. In February 2026, Ripple received conditional approval for RNTB, a major milestone. This isn't just a minor regulatory checkbox, it's a tectonic shift for the ecosystem. By mid-2026, RNTB is expected to secure direct access to FedWire and FedNow, which effectively positions Ripple as a regulated bridge between the Federal Reserve and the digital economy. In simple terms, this allows banks to move real money and digital assets instantly, safely, and efficiently. It's like giving XRP a professional-grade engine to power the Internet of Value. Next, consider the global nodes and institutional integration. Major banks like BNY Mellon in the US, SBI Holdings in Japan, and Standard Chartered in the UK are not just experimenting, they are actively using XRP and RLUSD for real-time liquidity and reserve management. These nodes are creating a network of financial infrastructure that is faster, cheaper, and more transparent than traditional banking rails. For example, BNY Mellon has already launched a tokenized deposit service and serves as a reserve custodian for RLUSD. This integration shows that XRP isn't just a speculative asset, it's becoming a functional pillar of global finance. Let's connect this to liquidity. The XRP ledger now settles transactions in under 5 seconds compared to legacy banks' T+2 settlement times. This speed is critical for institutions that need instant liquidity to manage billions in trades. Large players like LMAX Group have invested $150 million to integrate RLUSD as a core collateral asset, allowing them to settle multi-billion-dollar trades 24/7. The takeaway is clear. XRP is becoming an operational tool, not just a token to hold. Now here's why this matters for retail and professional investors alike. When liquidity is professionalized, the market becomes less volatile and more predictable. Institutions aren't trading based on hype. They are optimizing for efficiency, compliance, and risk management. This creates a new baseline for price stability, especially around key support levels like $150. While retail traders panic during dips, institutions quietly accumulate and structure the network for long-term growth. Another important factor is global adoption velocity. As we mentioned before, XRP surpassed 7.5 million unique wallets and daily transactions are surging. But now, with RNTB approval and global bank integrations, the ledger is transitioning from speculative use to operational use. Institutions are building a floor, preparing for a multi-year growth phase that could redefine how money moves internationally. This is the type of structural evolution that historically precedes major bull cycles. Here's a visualization to keep in mind. Imagine XRP as a global train network. Retail might focus on a few local stops, but the institutions are building high-speed rails connecting continents. Every new node, whether in Japan, the US, or the UK, increases the speed, security, and utility of the entire system. And these improvements aren't theoretical. They are live and actively processing real transactions. First, wallet data tells a very interesting story. From January to February 2026, the number of wallets holding 1 million to 10 million XRP steadily increased, with a net gain of 42 major whale wallets. While the price was temporarily dropping, these high net worth holders were quietly absorbing retail panic sales. This shows a deliberate accumulation strategy rather than random buying. It's institutional players positioning for the long term. Next, consider exchange reserves. XRP on centralized exchanges is at a 7-year low of 1.7 billion coins. Combine this with the rise in wallet numbers, and you get a supply shock scenario. Fewer tokens are available for immediate sale, while demand continues to grow. Historically, supply shocks like this precede significant upward price movements. The whales aren't just holding, they are preparing the market for the next big phase. Now, let's talk about the XLS66 lending protocol, a game changer for the XRP ledger. Traditionally, investors had to sell assets to generate yield or rely on risky third-party smart contracts. XLS66 changes that. It allows XRP holders to use their tokens as collateral to earn passive yield directly on-chain without selling a single coin. This transforms XRP from a simple asset into a productive financial tool, similar to a corporate treasury earning interest while holding cash. This lending protocol is also attracting market makers and institutional lenders who need instant liquidity to settle trades efficiently. By providing predictable yield opportunities, XLS66 encourages whales and professional holders to keep XRP off exchanges, further tightening supply. The result, reduced selling pressure, growing network utility, and a potential boost in price once the market reacts. Daily transactions and usage also prove the ledger's strength. In January 2026, XRP transactions ranged from 1.45 million to 2.68 million per day, with a success rate of 76% to 92%, showing that the network can handle high real-world utility. This is key because whales are not just holding, they are actively participating in the ecosystem, using their XRP to generate returns and contribute to the ledger's health. Here's another insight. The combination of whale accumulation, XLS66 adoption, and low exchange reserves creates a powerful flywheel effect. More tokens are locked in productive uses, reducing available supply. At the same time, adoption grows through new wallets, active transactions, and institutional participation. Over time, this creates a market where price must eventually reflect both utility and scarcity, not just short-term sentiment. Let's start with Evernorth. This $1.1 billion institutional vehicle is not just buying XRP, they are actively participating in the ecosystem. Their strategy is clear. Acquire XRP, deploy it into the XLS66 lending protocol, and generate yield while supporting network liquidity. This creates a flywheel effect. Corporate buying strengthens network utility, which attracts more adoption, which then draws in additional institutional capital. Unlike speculative trading, this is strategic market construction, building the foundation before the price catches up. Now consider the interplay between Evernorth and other institutions. With RNTB approval, BNY Mellon custody services, and banks like SBI Holdings and Standard Chartered actively integrating XRP, the network is no longer a niche asset. It's becoming infrastructure. Institutions are using XRP and RLUSD for real-time liquidity, cross-border settlement, and collateral management. These moves are happening quietly, away from social media hype, but they signal structural health that price alone cannot show. Here's why this matters for you. When supply is shrinking on exchanges, whales and institutional funds are accumulating, and network adoption is surging, the market is setting the stage for a significant price revaluation. Remember the $150 range we've discussed? This is no longer just a support level, it's the baseline for institutional confidence created by real-world usage, liquidity flows, and long-term accumulation strategies. The XRP ledger itself is evolving rapidly. With the adoption of the XLS66 lending protocol, whales can earn passive yield without selling. Daily transactions are surging, network stress tests show high success rates, and adoption continues to grow exponentially. The ledger is transitioning from a bridge currency to a programmable financial ecosystem, capable of supporting loans, collateralized transactions, and institutional treasury operations. This isn't speculation. It's real-world utility driving structural value. Now, let's talk about long-term implications. With Evernorth, RNTB, and global bank integrations, XRP is setting a foundation for multi-year growth. The convergence of adoption, utility, liquidity, and institutional participation is creating the conditions for a sustained bull cycle. Short-term price volatility may still exist, but the structural indicators are strong. Wallets continue to grow, whales are accumulating, and institutions are building infrastructure that can't be replicated overnight. Engagement time? Comment below if you're starting to see the bigger picture. While many traders focus only on daily price swings, professional investors track adoption, liquidity, network upgrades, and institutional strategies. That's the real roadmap for predicting future cycles. And if you want to track these moves in real time, joining a professional community or monitoring on-chain metrics can give you an edge over retail traders. Finally, let's summarize the key takeaway. The 49% price drop wasn't the end. It was the final shakeout before institutions moved in. Evernorth, whale accumulation, the XLS66 protocol, global banking integrations, and the growing ledger adoption all point to XRP's long-term strength. The Internet of Value is no longer theoretical, it's being built right now, and XRP is at the center of this revolution. The smart money isn't waiting for a breakout, they're constructing the foundation, and when price finally reflects these fundamentals, the upside could be significant.